Welcome back to another episode. Today, we're going to take a closer look at Texas Instrument. The company just reported earnings and it's down roughly 8.6% after hours. On today's episode, what I want to do is take a closer look at what happened. What are some of the headwinds? Are there any tailwinds or growth opportunities for this semiconductor player? And more importantly, is this the stock I'm willing to add to my overall portfolio? Let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right. So if we look at the stock right now, we can see after hours, the stock is down roughly 8.6%. Now, what I think it's wild in the past 5 years, not counting this drop, the stock is up nearly 20%. Now, total returns is most likely a little bit higher due to the dividend yield that this company pay, but just on stock asset appreciation, it's pretty much nothing, especially after in the past 5 years, it's pretty much nothing, especially if you take a closer look at that price after hours, bringing it down to probably less than 10% of total return in the past 5 years. Now, this $165, I'm not much of a technical guy, but throughout the past 5 years, you can see that 165 has been pretty crucial in forms of both support and resistance for the company in the past 5 years. So this is what many might say kind of one of those key levels, and we're going to have to see how things react in the future. Now, I think this chart shows a lot of how Texas Instrument has changed dramatically over the past few years. This is last 12 months of free cash flow. And at the peak of December 2021, it was roughly $7.1 billion. Now, the company has seen, unfortunately, a correction in its market and at the same time increasing its overall investments in capital expenditure to build more form of manufacturing plants. And free cash flow has taken a massive hit, but we do see some growth right now. In the last 12 months, it's roughly $2 billion, up from a year ago where it was closer to $1.5 billion. So charts like this are all possible through fiscal.ai. Make sure to check out my special offer at fiscal.ai/Jose for 15% off, a platform I use on a daily basis. Now, what is happening with earnings? So the main reason the stock is kind of seeing a bit of a negative price reaction is guidance. Guidance for next quarter, we're going to see is a sequential drop. And unfortunately, management didn't paint a great picture. We're going to look at some charts, but first, I got a pretty great slide for you. So this is going to be a nice Q3 2025 deep dives on 3 risk, 2 growth opportunities, and outlook, and something investors might have missed. Now, risk number 1 is customers are a bit hesitant right now in how they're trying to build up inventory. Right now, they mentioned especially their industrial customers are hitting the brakes on investments. They are in a wait and see mode due to unclear international regulations and tariffs, which are directly impacting Texas Instruments outlook. So obviously, if we get some better outlook in forms of tariffs, this could help the stock be a lot more bullish. And any form of negative tariff news can create a massive side effect, as the company mentions that this is a really big impact in forms of headwinds right now. The uncertainty stalls new factories construction and capital expenditure, creating significant headwinds for Texas Instruments industrial segment. Now, the second risk, and it's most likely with the customers being a little bit slower, it's creating a slower than expected recovery. Now, if maybe we can jump into the revenue chart real quick, but here is the revenue of quarterly for Texas Instrument. We see on June the 22nd, we saw some peak in analog revenue. Since then, we still haven't hit the peak in a lot of markets, and we are kind of seeing small growth here and there, but we're still nowhere near the peak. So management mentions that the market rebound is proving to be weaker and more moderate than in previous cycles. The company notes that the market is still performing below its historical trend lines. And pretty much they're seeing the market getting back towards that trend line, but it's still below. And it's one of the most, you have to go back longer in history to see a market that's taken this long before. And unlike past recoveries where customers rebuilt inventory, this cycle shows continued caution, prolonging the downturn impact. And it's more than likely that this caution in inventory is happening due to some of the things we mentioned before, like the tariffs. Now, risk number three is near term margin pressure. Gross margins are facing multiple headwinds to solve from lower revenue, higher depreciation cost. They saw kind of 1.8 billion to $2 billion in depreciation cost on inventory this year, and reduced factory loadings to normalized inventory. As you start to produce less in factories to kind of normalize as your utilization in factories gets lower and lower, margins also take a hit. Additionally, restructuring charges from winding down two older 6-inch fabs will continue to weigh on profitability through the first half of 2026. So right now, these are, in my opinion, three of the biggest risk impacting the stock, and we're going to see what they gave us with Outlook in a bit. But before we're going, if you're new to this channel, make sure to hit the thumbs up and the subscribe button. My end of year goal is to hit 85,000 subs by the end of the year. And this is the best place you're going to find any semiconductor and AI news. Now, if you want a free AI chip newsletter, check out whatthechiphappened.com. I'll be covering a lot of great earnings happening right now. It's free. There is a paywall for more deeper analysis, but the free version has tons and tons of information. Now, there's a lot of companies that I work with that I personally use. Make sure to check out fool.com/Jose, fiscal.ai/Jose for 15% off. I have a special offer with Moomoo, and I also have a special offer with Transpider. So all that helps out the channel if you want to continue to help me make great content like this. Now I want to talk about opportunity for the company, right? Because it's not all negative. We want to learn about some of the tailwinds available for Texas Instrument. Now, the first one is the data center acceleration. The data center market is TI's brightest spot, growing at an astonishing rate. It's the only area where customers are aggressively investing and expanding capital expenditure. Year to date growth was over 50% to a $1.2 billion run rate. That's the only place where they see strong growth, where customers are investing faster and faster. So for those that are not familiar, right, Texas Instrument has a lot of analog solutions. Analog solutions are used in all types of amazing AI chips for things like power, for signal control, for voltage control, and the list goes on and on. So that's definitely a good growth opportunity. Now, the opportunity number two, and this is their long-term portfolio expansion. TI is focusing its investments on three key markets, which I believe are great with massive long-term potential. The industrial space, which I believe can definitely go good with things like the robotic space and AI robotics. I'm not talking about humanoid robotics, even just your typical one-handed, your handed robots go a long way in the industrial market. Add AI to it, it can increase the market TAM of that. The automotive space, more chips are needed in cars, not just smart cars, but and not just autonomous driving cars and not just electrification cars, but all those are within a massive TAM itself. So that is also there. And data center, right? Data centers, as we see, continues to be a market opportunity. So those, to me, long-term opportunity are just in line of what the market is seeing growth in. Now, there is one thing that I think maybe investors might have missed from this earnings, but starting in quarter one of 2026, Texas Instrument will report data center as its own standalone market segment. And this is crucial change for investors as it's going to show this high growth, 50+% business is currently hidden, but we will start to see those numbers in the revenue and report it, which could create maybe a nice bullish sentiment towards the overall stock. Now, right now, it's hitting across multiple categories like enterprise systems, like communication equipment, like industrial. So compute equipment, switches, wired communications, optical modules, high voltage power delivery, PSUs. So it's just going to show the overall exposure that Texas Instrument can definitely win here in the AI space one way or another. Now, if we look at guidance for quarter four, unfortunately was 7% sequential decline from quarter three. Main reason they believe is going to be a roughly seasonal guide with ish in line, a moderate pace, right? So nothing to be excited about. Unfortunately, you don't want to see that sequential growth because let's kind of look back at the overall charts here on revenue. We haven't seen much of a sequential drop too much. But it does historically seem to happen in September, right? We see here September 2024, there was roughly $3.2 billion in revenue, in analog revenue. Then the next December of 2024, which will be similar here, dropped down by a few percentage points. So it's still in line, but the market does not want to hear sequential drop, especially during this AI space. Now, one great thing about Outlook was that at the end of the day, 2026 is focused on free cash flow. They're not for obviously gross profit margins is crucial, but free cash flow is their long-term focus. The CFO mentioned on a trailing 12 months basis, their free cash flow is up 65% from last year, and it has the potential to accelerate and grow even faster next year. So another 50-60% that could probably jump into by the end of next year, closer to $3 billion in free cash flow. Not where it was at its peak, but it's still improving and the growth opportunities are there. Now, I want to explain, is this a stock that I personally would buy? I'm going to say my answer is no, and I'm going to give a reason. I think the valuation for this stock is pretty expensive compared to its median, and the median eliminates a lot of random noise. So the median is forward. So this is based on future numbers. Forward price to free cash flow is 24. Even before this drop, it was trading around 39. It's not even a 10% drop, so it will still be in the mid 30s. I believe it's still expensive. If we're looking at forward PE ratio, very similar. It's still, even after this drop, is still trading above its median. And the final chart I want to showcase is this, is kind of comparing Texas Instrument, which is purple or pink, whatever you want to say, to the QQQs, which is green, and to a semiconductor ETF, SOXX, which is orange, and look at the overall price change and which one has performed the best. Now, Texas Instrument has pretty much been dead money in the past 5 years, and it has not outperformed any of these players. And if it ever didn't underperform, it was pretty much performing within market standards. We can see here in 2021 and 2022, it was just performing in line with the market. I believe that would be the same case. So instead of me buying Texas Instrument, I think I would be more inclined to either buy the Qs or to buy a semiconductor ETF where I can still get a dividend from them, but I expect them to be more market movers opposed to a Texas Instrument, which I believe it does have the opportunity to do better, but I'd rather just invest on those ETFs instead. So I hope you guys enjoyed today's episode. I do have two other earnings that I could cover. Would love to hear on the comments below if you want any of them. Galaxy Digital reported earnings this morning, and Intuitive Surgical reported and is up 17% after hours. Let me know in the comments below if you enjoyed any of them or you want me to do any of them. Take care, have a good day, and see you all next time.